Hello, my name is Shivda. Today we're going to look at bonds. Doing the very basic of bonds, what they are, how they work. So, in finance, there are really two kind of contrasting instruments that are often looked at. We have stocks, equity, and we have bonds. Now, bonds are a type of debt instrument. There are other types as well. But, bonds are often looked at the stable, less sexy equivalents of, stocks in which you can make a lot of money, in which you can lose a lot of money. Stocks are really looked at as more exciting, and bonds are looked at as more stable and safe. Bonds are also, along with other instruments, called fixed income, as opposed to equity and stocks, which is really to say that if you were to hold a bond till maturity, in other words, till the time that expires, you know exactly how much income you'll get. You know what the rate of interest is, you know when you'll get that income, and how much it'll add up to at the end. That's why it's really a fixed income, whereas there's nothing fixed about stocks. They may go up, they may go down based on various factors that really nobody can predict. People try a lot and try really hard, and some people have with some success, some people don't. But anyways, that's a different story. So now bonds and stocks are really used by companies to raise money. So when a company starts doing its work, it can either give away part of itself, in other words, give ownership to other people, give them a stake in the company and voting rights, etc., through issuing stock. So people who buy stock would actually own a part of the company, whereas they could also create bonds and issue bonds, which are really loans. So a bond is really nothing but a loan. And let's see how that works. So if you have person A and person B, the person who really creates the bond is called the issuer, while the person who has the bond is really the person who's the lender. So let's say B has a bond. You can think of a bond as an IOU. So if B has the bond, which originally used to be a piece of paper, now it's all electronic, and it really means that he's the one who's lending money to the person who issued the bond and gave it to B in the first place. So A is the borrower. So this sometimes it's not really tricky, but it sometimes takes a little time to remember and get one's head around. The issuer is the one who gives away the bond. He creates the bond in the first place, and he's borrowing money. He gives away that IOU. B has that piece of paper which shows that he has some claim to some money later on. So bond is really nothing but a loan. And there's some technical terms relating to bonds which we looked into. Now, of course, nobody wants to loan their money for free. So just like a loan pays interest, a bond also pays interest at a fixed or floating rate, given a certain schedule. So you have fixed or floating rate bonds depending on whether that interest rate is fixed or varies. For example, if it's floating, it could be pegged to various indicators, for example, LIBOR. Usually, so let's see, so we have an interest rate R, which is also called the coupon. And this is now usually expressed as a percentage per annum. So if you have a bond whose inherent value, face value, which we'll come to in a minute, is say $100, and you have an 8% coupon, that would pay $8 at the end of the year, 8% of 100. But usually, and I mean this is no hard and fast rule, but usually the interest payments are made semi-annually, so twice a year. So there would be two interest payments of $4 each, rather than one big interest payment of $8 at the end. Now the value that is borrowed, that borrowed value, the bond is nothing but a loan, right? Somebody's borrowing money from another. That borrowed value is called the face value or the par value. It's the principal that's borrowed. And a bond has a maturity date. In other words, that's the time after which this face value must be repaid. Just like a loan, you pay interest, but you also have to repay the original principal after a certain amount of time. So that time is called the maturity, and the date on which it's supposed to be repaid is called the maturity date. And this could be anything from 1 day to 30 years. You have 30-year-long bonds. And an interesting point to note is that the longer the maturity date, in other words, if the time to repay is longer, the interest rate is higher. And the reason is, a long maturity bond has higher risk. You know, if a bond which expires in 1 week, you know interest rates are likely not going to vary very much. You have a 30-year bond, you really don't know what the interest rate is going to be 30 years later, so there's much more risk involved. And to compensate for that risk, the interest rates that the lender would get would be much higher. So we would say maturity is proportional to interest rate. Higher maturity, higher interest rates. Now, an important point to note is that the price of a bond is something which is different than the face value or the par value or the borrowed value that we talked about here. In other words, this value, the face value, the par value, the borrowed value, is a constant. It remains constant throughout the life of the bond. Whereas the price can actually go up and go down. And price is intimately connected with something called yield, which can also go up and go down. So just think of price and yield as variables of the bond that can move around. They can go up, go down, change their values, while the equivalent stable parameters are the face value and the interest rate. The interest rate, again, actually can vary if it's a floating rate bond, but if it's a fixed rate bond, assuming then the interest rate is constant. Alright, so, but before we get into that, let's quickly take a quick diversion and look at types of bonds. You know, the government can issue bonds. U.S. Treasuries are bonds issued by the U.S. government. Companies as well can issue bonds. And, you know, usually governments are much more stable than companies. They have a lot more resources at their disposal. They're much less likely to fail. And so bonds issued by companies are much more secure. There's much less risk associated with them. And so, the interest rate that companies would pay, or the yield that companies would pay, would be higher because they have to compensate for that higher risk compared to, you know, government bonds. The three main government bond rating agencies which rate bonds, give them different, you know, grades. AAA, I'm sure you've heard of the AAA rating of the U.S. Treasuries. And the main agencies that do these ratings are Moody's, S&P, Standard & Poor's, and Fitch. Alright, and junk bonds, you may have heard the term. Basically, if the rating goes below a certain minimum, which, you know, can be defined in different ways according to the different rating agency, then they call it junk bonds. I mean, nobody wants them. They're, you know, way too risky. You would really just junk them. Alright, so moving on, let's now look at the yield and how it compares to interest rate. So now we're really going to talk about price and yield as opposed to the par value and interest rate, which are fixed. Right, I'm going to raise this little bond versus stock explanation at the top, and let's look at yield. Alright, so when people talk about yield, they're usually talking about the yield to maturity, which is a little more advanced calculation. And it involves, you know, taking into account reinvesting the interests made on that bond at the same rate, the rate going at that time. But which, you know, it could be going at that time as a floating rate bond. It would be fixed if it was a fixed rate bond. But we're going to take a simpler version of the yield, just to basically illustrate the concepts going on here. So yield really represents a return on the bond, and a simple formula for yield, which preserves all its properties, is defined as follows: yield equal to coupon upon price. So we know that the coupon is fixed. This is nothing but the interest rate R, right? Notice that the face value doesn't come in here. But then these two quantities are the ones that vary. Remember we said the price as opposed to face value, which is constant, can vary. And the yield can vary as opposed to R, which is constant. So notice these two quantities vary to keep this equation balanced. And like I said, the real equation is a little more complicated, but there's a simplified version. So really we see that yield is inversely proportional to price. In other words, the higher the price of a bond, the lower the yield. And the higher the yield, the lower the price of the bond. So that's a common relationship that you'll see all the time that comes up. Basically, if a bond costs more, right? You pay more money to get into to buy that bond, then you're going to pay less money in interest rates in the yield. That's a kind of a good way to look at it, and vice versa. So this is really probably the most tricky concept that arises when we're dealing with bonds. Everything else is rather straightforward, all definitions. And to finish up, I'd like to again some more terminology. Basically, you may have heard the term bills and notes. So bills are bonds that have a maturity of less than 1 year. Notes have a maturity of 1 to 10 years. And finally, bonds per se are supposed to have a maturity of greater than 10 years. So this is some important terminology to keep in mind. They're often all called bonds. But yeah, that's it. So just to recap, a bond has a principal value, a face value, a par value, which is really the amount borrowed, and it has an interest rate, which could be fixed or floating, but let's just say it's fixed for now. We're dealing only with fixed rate bonds. Then there's price and yield, which both vary. And so, the bond does not have to be held to maturity. You can sell the bond in the market even before it expires. Somebody else may be, willing to buy that bond and take on the onus of having to pay back the initial lend of the entire amount. So, the bond, the price at which people in the market are willing to buy that bond varies continuously. And so does the yield, which really is a good measure of the return on the bond. And they vary inversely to keep this relationship, which mind you is just an approximation. The yield to maturity is what we usually deal with, but they vary inversely to keep this equation holding all the time. So if yield increases, price decreases, and if price decreases, yield increases. Thank you very much.